We have Mr. Parvat Srinivas Reddy, who is the Managing Director of MTAR Technologies, joining us on the show. Mr. Reddy, good having you. Thanks so much for taking the time out. And I understand there is also an analyst meet that you have today. Is that correct, sir?
Yeah, that's correct.
Okay.
We have an analyst meet in Mumbai today, yes.
Okay, so when I look back at your results that came in beginning of February and the flavor or the color that you gave for Q4, as well as probably a 30% guidance that you gave then, versus 24th Feb when you're talking to analysts today, is there a change, sir? Has business optimism improved? Have things maybe plateaued? Is there what's happened in Q4? Can we start with that?
No, Q4 we are going as per the guidance what we have given, and
Okay.
what's more important is it will be also with improved margins, and we'll sustain those margins over the next 1 year and improve. The way I've said, we'll have a revenue growth of 30% year on year for the next 3 years with improved EBITDA margins at 24, 26, and 28%. So we stick by it, and we have done enough work over the last couple of years to improve various verticals, whether it's in defense or aerospace or other sectors. And we have done substantial work. So that's the result what we'll be getting over the next 3 years.
So I'm guessing what you're saying, sir, is that while the H1 wasn't the strongest, you had a pretty strong Q3. That momentum has continued into Q4, and I'm presuming that will continue to FY26 as well. Would that be a fair summation?
Yes, absolutely, yes.
Okay, and just a follow-up there, because Q3 almost everything clicked for you, right? Clean energy, space, product segment, everything clicked simultaneously. Would you reckon it's a combination of everything that does well, or is there a first amongst equals from amongst the segments that you cater to?
No, presently we are doing pretty well in all the segments and growing pretty well as well. So on quarter basis, every segment, every vertical, every engine is going to fire better and better. That's how we're going to have this kind of revenue growth happening on a diversified sectors which MTAR is involved. We're just not involved in one sector, we're involved in multiple sectors. And we have done a lot of R&D and new development work to be where we are today and to be where we are going to be in the next 3 years.
Mr. Reddy, my question coming to you is on two segments. First, let's talk about nuclear energy, because that's a big segment that you're betting big on. Clearly, you have, I mean, the opportunity is from the government's plan to construct 40 new nuclear reactors. Now, from where you are in terms of your current order book, where do you plan to get it? Because you clearly mentioned earlier 1,000 crores from Kaiga 5 and 6 reactors. Plus, if you talk about the current civil nuclear order book, that potential could go up to 1,500 to 2,000 crores in 6 to 7 years. So let's look at FY25, 26 and 27. What's that revenue potential and any margin creativeness that you see out of it?
First, let's look at the orders that we're going to get. That's most important. And with Kaiga 5 and 6, and also the refurbishment reactors, which are under the pipeline over this year, we are expecting close to about 800 to 1,000 crores of orders coming in. Now, what's important here is that all these orders have to be executed over the next 3 years' time. And we also have existing orders on hand. So the nuclear, I'm not going to go into a very long story about how many reactors are going to come and when they're going to happen, but we have enough on the plate right now to execute close to about 800 to 1,000 crores of orders over the next 3.5 years. And that's substantial, which never happened in the past. And it will continue to move in that direction even in the future. So that's what is very exciting right now.
Okay, so what will be your average execution rate then on a yearly basis from here on?
See, we're looking at, once these orders come in, right now we are looking at about, if you look at FY26, we are looking at nuclear doing at around 100 crores plus. But if you look at FY27, it will jump to about 200 and 250 crores. That's how exponentially it's going to grow year on year basis. And then we are going to execute all these orders. Obviously, we have to do it within the next 3 years. So obviously, you can see that kind of growth that's going to happen in this sector.
Doubling is what you're seeing between 25 to 26. And with regards to fuel cell industry, very quickly, if you could explain to our viewers in terms of what would this business contain and how big is it for you?
It's pretty big for us, but right now it's not only the fuel cell, which we have been doing for quite some time. We're also increasing our wallet share within the same segment as well, with the same customer as well. But we're also focusing on many other segments where we are doing very well right now, getting qualified for the first articles and moving into batch and volume production. So fuel cells, yes, moving forward as well, we'll have a substantial growth year-on-year basis, the way the market is looking at or the way the kind of feedback we have right now. So it's going to grow at a similar pace year-on-year basis. So that should not be an issue at all.
Mr. Reddy, I just come back to the predictability of the linearity of growth and the possibilities thereof. Now, would you reckon that your 30% CAGR not a formal guidance, but a color that you've given, or maybe you give a formal guidance, I don't know. But let's say the color that you've given for the next 2-3 years, would it be linear or could it be patchy on a quarter-on-quarter basis? Maybe on an annual basis, you clock in that 30%, but would it be linear over the quarters or could it be patchy?
I think we have come to a stage where probably we'll move into the linear kind of growth, quarter-on-quarter basis. But for engineering firms, normally the second half is much better than the first half. But moving forward, probably that could change and become more linear quarter-on-quarter basis. We're just looking at that right now. But I think that's what is going to happen moving forward.
Okay. And one more would be around the strength of the cash flows and the receivables, and would that stay strong enough for you not to need maybe say any kind of further equity raising to execute orders and business, or could something like that happen as well? So two parts, right? How strong are receivables and cash flows, and would you need any equity fundraise in the next 12 months?
See, our cash flows are pretty strong. Our receivables are very good. And we also had an operating cash flow positive, more than 100 crores last quarter. And we are not looking at any kind of fundraising right now. Based on our requirements as of today, definitely we'll not be looking at that. We are comfortable with our internal accruals and taking care of our growth plan to fund it. It all depends on any substantial opportunities coming in, then we have to look at it. But as of today, the kind of roadmap we have, I don't think we are looking at that right.
Okay. Okay, Mr. Reddy, we'll leave it at that. Thank you so much for taking the time out and being with us. Lovely talking to you today. All the best. We'll look forward to talk to you post your quarterly numbers, sir.
Thank you. Thank you so much.